Get Rich Education is brought to you by Norada Real Estate and GREturnkey.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE, episode 150. Yes, the sesquicentennial installation of Get Rich Education here. I'm your host, Keith Weinhold, back to help you build your wealth, and I'm coming to you from Anaheim, California today as I'm here for a media event. We're talking about your real estate investing portfolio architecture today. And you know, it's an interesting time to build up a bunch of cash flowing real estate for yourself. In fact, I can make the case that constructing this is more important for you now than it was for your parents' generation or your grandparents' generation, and even why it's more important for you to build your real estate portfolio with a sound architecture now than it was in your great-grandparents' generation. And you know, a lot of it has to do with your avoidance of volatility. Yes, the deleterious effect of volatility on your portfolio stands to be a greater threat than it's been previously for a couple reasons. Reason number one is Donald Trump. Reason number two is interest rates. All right, first of all, you must properly evaluate the injurious effect of volatility on your investments. Okay, stocks are more volatile than real estate. In year one, if stocks lose 20% in value, then they would have to gain 25% just to get you back to even. And well, even is actually a net loss because you have to account for inflation. How about in year one, if stocks lose 50% of their value, they need to gain 100% just to get you back to quote unquote even, okay? Real estate is more stable than stocks historically. There is no panic selling in real estate like there is in stocks. One reason that President Trump is more volatile for the stock market is, and well, I think it's sort of obvious, whether you like him or not, whether you voted for him or not, those are not the questions. Either way, I don't think that you can associate the word predictable with President Trump. Okay, you've got to at least agree with me there. Well, the stock market hates uncertainty, you know, and the president constantly feeds us uncertainty. Some of his remarks last week basically caused enough defection of participants from Trump's business councils that Trump just decided to disband a few of those business councils, for example. Okay, definitely something that the stock market did not respond well to. Trump is not predictable. The second factor is that we have increased stock market volatility over time. We're talking about the last decade or more. And we should continue to in the future, and that's because bank interest rates are basically still essentially zero. How are those two things tied together? Okay, well, first, yes, the Fed did begin making quarter-point rate increases almost 2 years ago, but guess what? The banks still aren't raising interest rates on savings accounts and CDs because they know that they just don't have to, okay? The dumb money and the scared money is going to stay in the banks anyway, whether the bank gives you 0% or a 2% yield. So banks just don't have any incentive to raise them. Okay, people are used to those anemic rates that are even below the rate of price inflation. So therefore, what happens is the smart money stays out of banks. It doesn't want to go in there. So people keep it outside, therefore. They keep it outside of savings accounts, outside of money market funds and CDs, and instead, they invested into places like the stock market and the real estate market. It's a flight to yield. Well, that right there, that creates potential asset bubbles in stocks and in real estate and greater volatility. So both Donald Trump and zero zilch bank interest rates contribute to greater volatility. So you know what? The effect of this is over time. We're just talking long time horizons here, like even a decade or more. Well, this contributes to stocks going up in value and stocks going down in value more, and real estate prices going up in value more and real estate prices going down in value more. But you know what happens during all of this volatility? your rent check just keeps coming in. Your rent check just keeps coming in. That's really the bottom line here, and that's the macro trend that you should prepare yourself for and align yourself with over the coming years. A great strategy, a great real estate investing architecture to construct for yourself and maintain for yourself in the coming years is with residential real estate. That's one real estate type that has sustainable demand. In a recession or even in a depression, people are going to need to live somewhere. So cash flowing apartment buildings and single family income properties in at least 3 metro markets, that does a few things for you, okay? And you want to be in at least 3 because that way you're not subject to just one metro economy's economic fortunes and misfortunes. One of the greatest mistakes that real estate investors make is investing in only one market and only in their home market. Now, there are some certain advantages to local knowledge that you might have in your own market, but even if you can make the numbers work there, that's not the only place that you want to be. Okay, for example, Anchorage, Houston, and some places in North Dakota, they're markets that felt some pain when the price of a barrel of oil plummeted starting 3 years ago. And I'm invested up in Anchorage myself. I know I've been feeling it with rent incomes falling in aggregate 15% plus there over the last 2 years. So thank goodness that I'm invested in multiple markets. Now, sometimes it is not for strict economic reasons that a metro economy sees its fortunes decline. A few years ago, a lot of people felt pain from investing in Phoenix because of the way that some immigrants were policed had changed. So hedge yourself against these local phenomena. But now, I don't think that you want to be invested in like 12 metro markets, okay? I think if you do that, you could very well be over-diversified if you were investing in cash flowing residential real estate in 12 different markets. For one thing, that is a lot of markets for you to have to pay attention to with what's going on in their economic futures. And then secondly, with 12 markets, you would probably have 12 property manager statements to have to review every month. And that just gets to be a lot of moving parts. That could be indenting your all-important ROTI, your return on time invested. Now, you know something? A stock investor, they might say that they can spend less time managing their own stock and mutual fund portfolio than you as a real estate investor spends invested in multiple turnkey markets. And you know what? I would actually have to agree with that mutual fund investor. I would say that in general, there is less time involved with being a quote-unquote passive stock and mutual fund investor than there is a quote-unquote passive real estate investor. But you know what? The ROTI, that's not just time. It's return divided by time. And with stock investing, you're not achieving any real return. In fact, you're likely only experiencing a negative rate of return, like we've talked about so much on previous shows when you consider inflation, emotion, taxes, fees, and volatility. So with being a direct investor in real estate, you have up to 5 profit centers at the same time. 5. And that's why it's greatly advantaged on a return on time invested basis. So being invested in 3 or 4 or maybe 5 different markets, that's good. In good times and in bad times, people are going to need housing and they're also going to need food. And we've talked about how to passively invest in cash flowing agriculture on this show as well. Now, single family income properties don't work out that well in most U.S. markets on this important ratio of rent income to purchase price. So, I mean, yeah, you might be cash flowing real nicely on an apartment in Manhattan's Lower East Side if you either bought it 30 years ago or you made a 75% down payment, all right? That's about the only way, okay? The real estate markets that work best, you know, they're kind of those ones between the great mountain ranges of the United States, between the Appalachians and the Rockies, just real generally there, as there are a few notable exceptions close to the East Coast. And when it comes to single-family homes, you generally want to buy ones that are a little bit below the median price for that area. If the median price is $170,000, maybe ones at $125K work. You don't want to dip down too low, too far below the median. You'll end up investing in neighborhoods where the neighbors don't actually pay the rent. Right? That's the difference between physical occupancy, which means someone is living there, and economic occupancy, which is someone actually paying the stated rent. You don't want to buy a single-family income property that's too much greater than the median value in that metro, or else your rent income begins to slip proportionally to the higher purchase price that you would have to pay, and you no longer get cash flow. So we're talking about your real estate portfolio architecture today. Now, how do you buy property where you can best benefit from all of real estate's 5 simultaneous profit centers? Yes, there are 5, and I'm sure that longtime listeners can recite those 5 with me now. Number 1 is appreciation. Number 2 is cash flow. Number 3 is loan paydown that's outsourced to tenants. Number 4 is generous tax advantages. And number 5 is the inflation hedging benefit. Now, numbers 3, 4, and 5, they're just generally going to happen over time. So let's look at the first 2, appreciation and cash flow. They're kind of the biggies, okay? How do you find a market where you get both appreciation and cash flow? The short answer is with a blended portfolio. A market like Dallas-Fort Worth is where a lot of people expect appreciation in coming years. And, we've used that example before. So let's use Charlotte, North Carolina instead. Another market where, like Dallas, cash flows today are thinner, but you have the great expectation, and certainly no guarantee, but a great expectation of appreciation. So let's say you buy 10 properties in Charlotte, 10 in a cash flowing market like Memphis or St. Louis, and then maybe 10 more in a place like Kansas City, where we'll say that you get a blend of both a little appreciation and a little cash flow there in KC. Well, okay, that's it right there. That's how you can get a good measure of all 5 real estate investing profit centers when you tie up those properties with long-term fixed interest rate 30-year amortizing loans. Some might be apartment buildings, some might be single-family homes. Now, maybe you're looking at your situation, you're looking at yourself, you're looking at your resources, and you're thinking that you might only have the ability to buy 10 cash flowing properties over the next few years. Now, you're figuring that each of your properties might cash flow $250 for you. So that's $2,500 per month or $30,000 of passive annual cash flow that you'll have for yourself. And you're thinking, all right, now how in the heck is an extra $30K per year really going to be life-changing for me? Well, you're asking yourself a great question, and the answer is that it gets a whole lot better than just that $30K. For one thing, over time, when you tie up property with long-term fixed interest rate debt, your cash flow rises faster over time than the rate of inflation does. So your $30K of passive monthly income, or rather passive annual income, will generally rise faster than inflation. All right, so why is that? Well, your rent income generally only rises at an inflationary rate, but your expenditures associated with the property rise slower than inflation. That is because your greatest expense associated with each property, which is the principal and interest, is a fixed expense. Say that you have a $500 monthly principal and interest payment on a property today. That will still be an expense to you of only $500 per month 10 years from now. And in 10 years, inflation would make wages higher, prices higher, and yes, rents higher. Yet your chief recurring expense tied to the property, that P&I, is still the exact same $500. So not only does your mailbox money increase faster than inflation, but you simultaneously have the impact of leveraged equity growth, which is clearly more substantial than lame, slow compound interest growth. Yes, I called compound interest lame and slow because that's all it is at any realistic rate. I wrote an article for the Risk Stat Advisors about how just at real estate's historic appreciation rate of 6%, which is what it is nationally and historically, your $100K of property equity turns into $300K of property equity in just 5 years when you start off leveraged at 5-to-1, meaning that you just make the minimum 20% down payments on income properties. That way, you can redeploy accumulated equity from your existing properties into new ones with cash-out refinances and 1031 exchanges, and sometimes without even adding much of your own additional cash. So, property equity is kind of paradoxical. The rate of return from equity is absolutely zero, so it's really best used as a powerful tool. You're just kind of moving this lever around into multiple properties, that power of leverage. When you take that accumulated equity and continue to spread it out across multiple properties, continually kind of planting small seeds with new mortgages that are conservatively serviced with tenant cash flow. It's kind of this effect where if you have 10 single-family homes and a couple have this accumulated equity, well then maybe you'll want to sell 2 and 1031 exchange them for a fourplex. So now you will have gone from 10 rental doors to 12 with little additional money out of your pocket. So buying in both cash flowing markets and expected appreciation markets kind of gives you each of these effects of cash flows that trump inflation and the power of leverage. And we've got to be careful with that term expected appreciation because it cannot be counted on. And even then, with 20% down payments, we don't want to be hemorrhaging cash flow, okay? So we're talking about stable markets. Typically in the Midwest and South is where we're talking about, not volatile coastal California, where we would be hemorrhaging cash flow and really just pinning our hopes on appreciation all the while. Prudently leveraged investments in stable markets, they can still capture relatively impressive appreciation benefits without the risk of a volatile market. Another thought with building your real estate portfolio architecture is that I don't plan to hold any property forever. Love people, love experiences, don't love things. All 1031 out of something when there's sufficient equity buildup and the time is right. In fact, I don't plan to hold on to any of the properties I currently own forever, except for maybe those cash flowing agricultural parcels that I have in Latin America. But I think you know that a mantra of financially free rather than debt free is a real credit to you in building your portfolio. I don't want to have any property in a paid off position myself. Just consider this. If your property is 100% paid off, you still have a monthly payment. Yes, if your property is paid off, you still have an opportunity cost payment, and that's as real as making monthly mortgage payments, and that's especially true in this low interest rate environment. It's just that you cannot see the opportunity cost payment that you're making. Let's say that your $500,000 home is debt-free, it is mortgage-free. Well, then you have $500,000 tied up in your home. All right, well, you would still only have the same benefits from living there as you would if you only had $25,000 tied up in your home. Okay, how much cash flow could that extra $475K be generating for you in income property spread across multiple markets? That would more than offset your extra housing payment. So just a different way of thinking about it there. You're making a payment either way. I'm strategically mortgaged to the hilt, and I'm comfortably mortgaged to the hilt because I have multiple streams of passive cash flow, and I hope that you do too. So it comes down to having good loans and originating them with a mortgage loan company that knows specifically what real estate investors need. That can really help you out. Check out Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. And in fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. So check out ridgelendinggroup.com and start a relationship with them in growing your real estate portfolio architecture. We're talking about building your real estate portfolio architecture here on the Southern California edition of Get Rich Education today, as I'm in beautiful Anaheim. It's been nearly 2 years since I was last here in SoCal. Can you believe that? Almost 2 years. We've been talking about some numbers, strategies, and tactics in building your wealth through real estate today, that vehicle that's made more ordinary people wealthy than anything else. Let's approach your wealth building from a different angle next. I'll be back in 45 seconds. I'm Keith Weinhold. This is Get Rich Education.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
This is Entrepreneur on Fire's John Lee Dumas. Don't follow money. Make money follow you with Get Rich Education.
Welcome back to Get Rich Education. We've been talking about your real estate investing portfolio architecture today. Live where you want to live and invest where the numbers make sense. The first time that I heard that in my life was from Robert Helms, and that is spot on. Well, we've been talking about investing where it makes sense, but the first part of that is live where you want to live, and I choose to live in a somewhat different kind of place. After I'm done here in Anaheim, I'll be heading back home to Anchorage, Alaska for only about a week, and then I'll be headed to Belize and then Costa Rica after that. Latin America will consume most of next month, so I might be doing a show or two from there, but yeah, Anchorage has been my hometown for a while now after being born and raised in Pennsylvania, and there's a good quality of life there in Anchorage. It really fits my interests well. If you truly invest where the numbers make sense, you can live where you want to live at some point, even if you don't live where you want to live yet. So many retirees have trouble making ends meet these days because they fell for the great Wall Street conspiracy and they invested in 401ks and the like. And sometimes their options end up being so few that they have to move to a state or out of the U.S. to a place that either has a low cost of living or has low taxes or both. Imagine designing a life for yourself that you had to end up living somewhere strictly due to its tax structure. I mean, that would be sad. And speaking of low taxes, did you know that my home state, where I reside more than 9 months a year, my home state of Alaska, has been named the #1 tax-friendly state by countless media sources that compile these sorts of things? Alaska has no state income tax, no state sales tax. It might be the only state like that. Additionally, my home city of Anchorage has 0 municipal income tax or sales tax. Plus, every state resident gets an annual payment just for being a resident. Maybe you've heard about those payments. That's called the Alaska Permanent Fund Dividend. It's paid out once a year. Basically, it's excess oil money, and that payment, it's only about $1,000 or $2,000 per resident each year, but that's on top of all the zero tax stuff. Oh, and plus, property taxes in Anchorage are about 1.25% of property value annually, so they're kind of kept in check too. Now, the cost of living is higher up there, but the price is worth it because the quality of life is higher to me anyway. So I guess that a high cost of living is a price worth paying for a high quality of life. Now, the other night before coming down here, I had a milestone wedding anniversary that I celebrated with my wife. Whew, besides just living in an area where things can seem overpriced, things got wildly overpriced for the anniversary. Quite the fancy night out there. Right? Why do life overpriced when you can do wildly overpriced, I guess? So let's talk about living abundantly. Living an abundant life really means maintaining an expansionary mindset. And I was writing about this recently, again, for the Risk Stand Advisors. I was writing that, in fact, you just cannot get ahead by being cheap. You can't shrink your way to wealth. And let's look at some examples of going through life living below your means versus going through life expanding your means, kind of metaphorically and concretely here, both of them. To acquire wealth, you need to focus on increasing your income, not reducing your expenses. You want to focus on production, not reduction. You just can't shrink your way to wealth. So this conventional wisdom of live below your means is bad advice. In a world of abundance, why settle for living a day below your means? Focus on expansion. So let's look at these examples of some of these are just your everyday decisions that shape your wealth potential. And it's really the sum of these parts that are going to determine whether you're living a life below your means or expanding your means. Okay, and the first one is an example of living below your means, and the second one's an example of expanding your means. You could spend years of your childhood either practicing to become the high school mascot or practicing to become the high school quarterback. You could spend an extra 5 minutes this week detouring to the cheapest car gasoline station or with your family because you arrived home 5 minutes sooner from the nearby gas station. You could spend an extra 30 minutes waiting in line for a free Chick-fil-A sandwich, or you could spend those extra 30 minutes expanding, learning about how credit scores work to get the best mortgage terms. You could spend an hour mowing your grass when the neighbor kid would do it for $25, or you could spend that hour in research to find your next income-producing property. You could spend the month living below your means by watching every season of Game of Thrones, or expand your means by watching half as much Game of Thrones and gaining financial education. You could spend the next 3 years yanking weeds at home so that you could save money and hope you'll live better someday. Or you could spend those next 3 years on 10 memorable family vacations and 5 seminar trips paid for from your income property. You could spend the next 10 years working voluntary overtime hours because your chief idea of income production is trading time for dollars over and over and over. Or you could spend the next 10 years having the time to attend your daughter's piano lessons and ice skating competitions. You could spend the next 30 years commuting to work. You commute just to sell your time for money at a workaday job that you might not even like, or you could spend those 30 years enjoying durable passive income streams and use that extra time to find fulfillment or create memories with loved ones. You could spend the next 40 years being a landlord. Every tenant has your phone number and you've got an old pickup truck with a ladder rattling around in the back. Or you could spend the next 40 years checking on your income properties distantly with occasional emails to a trusted property manager who you've built a relationship with. You could spend your investor life thinking debt-free or thinking financially free, or your mindset and work habits consist of either hauling water buckets to the garden every day or setting up a sprinkler system in the garden once. So that's it. Really metaphorically, are you hauling water buckets to your garden every day? Or are you setting up a sprinkler system in the garden one time? You can either choose a life of living your fears or a life of living your dreams. And, in life, settling for less kind of correlates with regret. Just look back on your past. Okay, you're more likely to regret what you did not do, not what you did do. A rich person digs for gold. A poor person is concerned with the cost of a shovel. In life, there's a little something to be said for delayed gratification, but so many people could be doing more with their life if they did not delay so much gratification. We convince ourselves that our life's going to be better after we get married or after we have a baby or then another. And then we're frustrated later that, now our kids aren't old enough and we'll be content when they are. And then after that, we're frustrated that we have teenagers to deal with. Well, we'll certainly be happy when they're out of that stage. We tell ourselves that our life will be complete when our partner gets his or her act together, and when we get a nicer car, or when we're able to go on a nice holiday, or when we retire. Well, the truth is there's no better time to be happy than right now. If not now, then when? Your life is always going to be filled with challenges. So it's best to just admit this to yourself and decide to be happy anyway. And I want to close out the show today with a quote that comes from Alfred D. Souza. He said that for a long time, it had seemed to me that life was about to begin, real life. But there was always some obstacle in the way, something that had to be gotten through first, some unfinished business, some time still to be served, or a debt to be paid, and then life would begin. At last, it dawned on me that these obstacles were my life. This perspective has helped me to see that there is no way to happiness. Happiness is the way. So treasure every moment that you have and treasure it more because you shared it with someone special enough to spend your time. And remember that time waits for no one. So stop waiting until you lose 10 pounds, until you gain 10 pounds, until you have kids, until your kids leave the house, until you start work, until you retire, until you get married, until you get divorced, until Friday night, until Sunday morning, until you get a new car or home, until your car or home is paid off, until spring, until summer, until winter, until your song comes on, until you've had a drink. There is no better time than right now to be happy. Happiness is a journey, not a destination. That is from Alfred D. Souza. That is wonderful. If you want to expand your means, be sure to be signed up for our free newsletter at getricheducation.com. In fact, if you are, you'll find out about the Philadelphia Buy, Renovate, Refinance opportunity coming this Tuesday, August 29th. That's another actionable opportunity. And, I actually go to these markets. I am in these places. I visit them and I get a relationship with the provider. The cash flowing sweet spot in Philly, that's a place I've been and I've toured it with the provider. Same as in Little Rock, Arkansas, like we discussed last week. Same with St. Louis, like we'll be discussing in the future. Next week, we're going to be talking to a real-life real estate investor, a Get Rich Education listener just like you. How is his real estate portfolio architecture looking? What are his challenges? How much passive cash flow does he have from listening to the show here? I have got to tell you that I really appreciate you spending part of your week with me. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, getricheducation.com.